Hello investors, this is Lukasz Labedzki, Senior Analyst at the Franklin Templeton Institute. Each week we'll cover the most important developments for investors, we'll look at what happened and how it impacts the markets so you can make smarter, more informed investment decisions. Today, let's talk about a hot topic in the bond markets recently. Growing issuance to finance AI investments. AI-related capex has been growing since 2022 and is expected to grow further, but this year has brought a pretty meaningful change. Hyperscalers have started tapping the debt markets to finance a portion of their investments, which previously hasn't been the case or was the case to a much lesser extent. What does this mean? Let's explore. Let's start with a quick look at the issuance patterns this year versus the 10-year average for investment-grade issuers on the left-hand side and high-yield issuers on the right-hand side. In both segments, issuance has been growing relative to the longer-term trend, but for different reasons. AI capex spending has largely been carried out by big tech companies with strong market positions and high credit ratings. So here we are talking about the left-hand side of the chart. Indeed, issuance in this segment has been slightly higher than the 10-year norm, and the gap has been widening in recent months. However, are we talking about a massive wave of bond supply? Not really. Hyperscalers have issued around 110 billion US dollars of debt year to date, far more than in prior years, but still only about 7% of total IG issuance in 2025. Enough to push yields somewhat higher, but not enough to cause major disruptions. As far as high-yield debt is concerned, growing issuance has been much less related to AI financing, as this segment has relatively low exposure to the tech sector. The main reason behind the increase is refinancing. Many companies took advantage of the lowest refinancing costs since 2022 and tapped the market. But markets are forward-looking, so we need to focus on what the future brings. According to a Morgan Stanley research paper, data center capex spending could reach almost $3 trillion US dollars through 2028. But it's important to consider how this spending is expected to be split across different funding sources. The majority of the capex is expected to be financed by cash flows. However, there is still a 1.5 trillion US dollars funding gap, which is likely to be covered by debt markets. Importantly, public corporate bonds are not expected to be the primary source of AI financing. They are projected to cover around 200 billion US dollars of the funding gap. Not much, considering the size of that market. The vast majority of financing needs is expected to be met by private credit markets outside of public exchanges. So, is it a threat or rather an opportunity? AI is one of the leading themes in the market. It is transforming not only capital markets, but also our daily lives. For a long time, bond markets had limited opportunities to participate in this trend. This has started to gradually change, and in general, it means a growing opportunity set, which is positive. It should also be mentioned that the big tech companies that have recently increased their bond issuance are fundamentally strong. The latest earnings season confirms strong earnings momentum in the segment. And what's important from a bond investor perspective is that these are cash-rich companies with relatively low leverage. which should positively impact demand for their bonds. However, we need to mention that the debt of tech companies tends to have longer maturities, which means longer duration. As we write in our global investment outlook, we expect somewhat steeper yield curves, and long-term yields may remain capped with higher risk-adjusted return potential on the shorter end of the yield curve for the time being. Getting back to fundamentals, the slide shows two basic fundamental metrics: net leverage and interest coverage versus the pre-COVID average. We show this for the median investment grade company on the left-hand side and the median high-yield issuer on the right-hand side. These fundamentals look generally okay, and for big tech they look even somewhat better. But one thing that's worth noting is the right-hand side of the slide, showing the more risky high-yield issuers. As you can see, net leverage for both US and Euro issuers is below pre-COVID averages, while interest coverage is above the pre-COVID average. Overall, the fundamental situation of the median high-yield issuer is okay, and this sector offers relatively higher yields paired with lower duration, offering opportunities that can potentially enhance the return potential of the core bond portfolio. Thanks very much for listening. Trade well. Cheers!